Here are three key things that I look out for in a quality REIT. The first thing I look out for is the quality of assets in their portfolio. So how do you know whether their properties are high quality or not? One way to tell is they have high occupancy rate. That means there's a lot of demand for tenants to always want to rent and lease their properties. So if there's high demand, there's high occupancy rate, that's a good thing. Another thing you want to look out for is they have a high occupancy rate, not because they're cheap, but because they're able to charge market rents or even above market rents and you still have demand in high occupancy rates. So the second thing I'll look out for is a gearing ratio of at least 40% or below. So you don't want a gearing ratio that's too high because that would be a bit more risky for the REIT, and you don't want a REIT to borrow too much money in case something happens and they can't fulfill their obligation. So gearing ratio of 40% below is great. So the third key thing I'll look for is DPU, or distribution per unit. So if you're investing in a REIT, typically you're looking for dividend income. So you want to see whether this particular REIT has a very consistent and growing DPU over time. I think that's the litmus test for any REIT. If they're able to do that for over 5, 10, 20 years, that's a quality REIT. So one thing you need to know is that a high quality REIT is usually popular with investors in the market. So they may have a higher price to book ratio. So what you need to do in terms of valuation is to compare the current price to book ratio with the historical range as well, and invest only when they are fairly valued or undervalued.